Okay, so this here is question 1 from TAT letter 106 of FAC4863, and I think it's the 2022 TAT letter. So we're doing question 1, which is Savemore. So Savemore includes leases as well as employee benefits. So we'll do the leases part today, and then tomorrow we will do the employee benefits. So they say Savemore Ltd is an online trading store that distributes its products from its various distribution warehouses in South Africa. The company has a 28 February financial year end and is listed on the Johannesburg Stock Exchange. Just give me 2 minutes. There's just someone at the gate. Okay, so in the first paragraph, what do we pick up? There is it's a 28 February financial year end, right? So so it starts 1 March, 28 February. Okay, so you want to have that in your head, or you actually want to write it clearly somewhere in your paper so you don't have to think about it. Okay. And what do? They distribute products from these various warehouses. Okay, so it looks like it's operating like takealot.com. Okay. So the COVID-19 pandemic not only caused the world to be more digital, but also affected online shopping behaviors in the long term. Savemore noted that online purchases have increased with up to 10% across most product ranges. But its market research indicates that consumers can afford only essential items and postpone the acquisition of expensive items. Okay, so just some background over there. To decrease its distribution costs, Savemore decided to move certain distribution warehouses closer to its customers. The company also had to increase its number of delivery vehicles to meet the increased demand for online sale deliveries. Okay, so number 1, lease of delivery vehicles. On 1 September 2020, Savemore entered into a contract with Transport for the right to use 10 delivery vehicles. Savemore will use the delivery vehicles for a period of 4 years. Okay, so when you deal with a lease question, you always want to identify who's the lessee and who's the lessor. So in this case, the lessee is Savemore and the lessor is Transport. Okay, so they the contract is stating the right to use 10 delivery vehicles and for a period of 4 years. Okay, so the lease agreement contains an option to extend the lease term for an additional year and another option to acquire the vehicles at the end of the extended lease term after 5 years. Okay, so what they are saying is an option to have to extend the lease for another year. So instead of having a 4-year lease, you have a 5-year lease. And there's another option where you can acquire, where you can purchase the vehicles at the end of 5 years. Okay, so take note of that. Lease payments will remain unchanged at the commencement of the lease. Savemore did not indicate that it intends to exercise any of the 2 options. Okay, so this is very important now. What we must understand is the following. Okay, when we calculate the lease liability, okay, the lease liability will have a few things that you need to include in the calculation. So although the contract has an option to purchase the vehicles at the end of the lease term, the fact that they're not intending to do so, it means we will not include it in the calculation. Okay, so that's very important to understand. Okay, so they're telling us that they're not intending to extend the lease and they're not intending to exercise the purchase option. So that means the lease term will be based on 4 years, and that also means that the option to purchase will be 0. Okay, so just take note of that. Okay, so according to the lease contract, the following residual value guarantees are required from the lessee. Okay, so if we use 4 years, it is 600,000, and 5 years, if ownership is not transferred, it will be 375. Okay, so you just take note of that. So at the inception of the lease contract, The useful life of the vehicles was estimated at 6 years. The economic value of the vehicles was estimated at 8 years. Okay, the following information was supplied by the financial accountant of Savemore. You may assume that the information below is correct. So it's very important to distinguish between the inception of the contract and the commencement of the contract. Okay, so that's important two dates to take note of. So here we can see the lease payment is 50,000 Rand per month. Okay, so it's 50,000 Rand per month. It starts on 1 September 2020, and they're just running it up until 28 February 2021. So that is basically how many months? 6 months: September, October, November, December, January, February. Okay, so that is just 6 months. Then here they're showing us the interest, so we can kind of work out what is the interest rate, and then what's the capital repayment. Okay, so we'll be able to work out what this interest rate is. Okay, so we must be able to work that out. Okay, so let's have a look. On 28 February 2021, so take note now, at the end of the financial year, the board of directors decided during a strategic budget meeting to extend the lease agreement with Transport to 5 years. The board also indicated that Savemore intended to acquire the vehicles at the end of the lease term. Okay, so now we must understand what's happening over here. On 1 September, that is when the contract started. Okay, so on 1 September 2020, that's the beginning of the contract, the commencement of the contract. Okay, so at that date, they decided that they will not extend the lease, and they will not exercise the purchase option. So therefore, when we worked out the lease liability at that date, at 1 September 2020, what did we do? We used 4 years as the lease term, and we used what's the other thing that we used? And we used and we included 0 for the purchase option. Okay. Now at 28 February 2021, they have decided that they want to exercise the purchase option, and they want to extend the lease to 5 years. Okay, so now there's a change in this whole lease thing. Okay, so now we have 2 options over here. Either this becomes a remeasurement, or this becomes a modification. Okay, so because the change relates to a lease term and it relates to the exercise of a purchase option, and both items were in the original contract, that means it is now a remeasurement. Okay, if these items were not included in the contract, then it would have been a modification. Okay, so let's say the original contract didn't have those options, and they renegotiated with the lessor to include these options, and that means the lease would have been a modification. But in this instance, because it relates to items, the lease relates to the lease term, and it relates to a purchase option, and both items formed part of the original contract, it becomes a remeasurement. So with a remeasurement, what we do, all we do is we have to adjust the lease liability. And as a result, because we're adjusting the lease liability, it also adjusts the right of use asset. Okay, so just take note of that. And what's important to note, this type of remeasurement, we have to use a revised discount rate, meaning the discount rate at 28 February 2020. At 28 February 2021. Okay, so just take note of that. Okay, so they say Transport announced that the acquisition price of each vehicle will amount to 30,000 Rand at the end of the 5-year lease term. Savemore incurred legal fees of 29,384 with regard to the finalization of the original lease agreement. Transport also incurred, but Savemore does not know the amount. Savemore's annual monthly compounded incremental borrowing rate was determined as follows. Remember, we only use the incremental borrowing rate if we can't determine the rate implicit in the lease. You always want to make use of the rate implicit of the lease unless you cannot determine it. And if you can't determine the rate implicit in the lease, only then do you make use of the incremental borrowing rate. Okay, so just take note of that. So let's say you may assume that the lease agreement complies with the definition of a lease in terms of IFRS 16 leases, and that Savemore accounts for the right of use asset according to the cost model in terms of IFRS 16 property, plant, and equipment. Depreciation is accounted for according to the straight line method. Okay, so that is basically it. Okay, so now we're going to focus on this part of the question, and I'm going to go now to the required. So they say, assume that only the initial recognition of the lease transaction with transport was correctly accounted for. Just so the initial recognition would have been 1 September 2020. Okay. Discuss the subsequent measurement of the lease transaction with Transport Ltd in the financial records of Savemore for the year ended 28 February 2021. Now I'm going to stop sharing and let me just explain what, okay, I'm going to keep it on here. So we know what is happening over here, right? We know that there is a modification. I mean, a reassessment. Okay. You can't hear anything. Yes, we are talking. So there is a modification, right? So there is a reassessment. But for now, let's ignore the reassessment. Let's ignore the reassessment, okay? So for the reassessment, let's ignore that. Assume this was just a normal lease. What would the subsequent measurement be for a normal lease? There'd be two parts. I mean, for normal lease, for lessees, okay? There would be two parts. The first part would be relating to the right of use asset, which would be basically depreciation. And the second part would be the subsequent measurement journals relating to the lease liability, which would simply be the interest expense as well as the capital repayment. Okay, so that is basically the two parts when it comes to subsequent measurement relating to lessees. So there's two parts under normal circumstances. One, the journal entries relating to the right of use asset, which is simply depreciation. The journal entries relating to the lease liability, which is basically the payment of the lease and then with that comes the interest expense and the impact on the lease liability. Okay, so those are the two normal subsequent measurement transactions for lessees. So that is basically what we're going to be doing. Okay, but then over and above that, at 28 February, which is at year end, we're going to have to perform a reassessment of the lease liability. Why? Because the board have decided to extend the lease term to 5 years, from 4 years to 5 years, and the board have decided to exercise the purchase option. So both those items, the lease term, the extension of the lease term, as well as the purchase option, was in the original contract. So because those two items were in the original contract, deciding to exercise those options implies that it is not a lease modification, but a reassessment of the lease. Okay, and in this circumstance, we will make use of a revised discount rate. So that's going to be the third aspect that we're going to be dealing with. Okay, so I just want to switch over into IFRS 16, and then I'm going to read through to you the reassessment of the lease in terms of IFRS 16, so you can see where it is and how I came about that conclusion. Okay. Okay, so here is IFRS 16. So start with paragraph 39. They talk about a reassessment of the lease liability. So they say after the commencement date, a lessee, so remember after the commencement date, a lessee shall apply paragraphs 40 to 43 to remeasure the lease liability to reflect changes to the lease payments. So now we know there's going to be changes to the lease payments because of the exercise option and because of the exit lease term. Okay, so now we know there's a change. A lessee shall recognize the amount of the reassessment of the lease liability as an adjustment to the right of use asset. Okay, so that just means, let's say the lease liability is increasing. So we're going to say credit lease liability with the change. Okay, because the lease liability is increasing. Let's just say it's going from 100,000 to 150,000. So there's an extra 50,000. So we're going to say credit lease liability 50,000. For every credit, there must be a debit. So they are telling us that the other side of the transaction or the other side of the journal is going to the right of use asset. So that means it will be debit right of use asset. Okay. And they just give some further nuances to say, if the carrying amount of the right of use asset is reduced to 0, and there is a further reduction in the measurement of the lease liability, a lessee shall recognize any remaining amount of the remeasurement in profit or loss. So in this case, they're talking about if the lease liability is decreasing. So let's say the lease liability decreases. So we're going to say debit lease liability. For every debit, there has to be a credit. The credit has to go to right of use asset. But they are saying if the credit takes the right of use asset to 0, and there is still a remaining portion. Let's say we took 50,000. Let's say the reduction is 50,000, but the right of use asset is sitting at 30,000. So that means we can only take 30,000 Rand to the right of use asset because now the right of use asset is 0. But we're still sitting with a difference of 20,000. That 20,000, they are saying, needs to go to profit or loss. And you can just call it remeasurement of lease liability, P&L, whatever you want to call it. Okay, so that is just basically what they are saying in this paragraph. Okay, so they're just explaining what do you do with a remeasurement of the lease liability. You take it against the right of use asset. You only take it to profit or loss if the right of use asset has been reduced to 0. Okay, so that's what they're just saying. Now they say a lessee shall remeasure the lease liability by discounting the revised lease payments using a revised discount rate. Okay, so they're telling you that you will remeasure the lease liability using the revised lease payments and using a revised discount rate. But when do you do that? If only in these two circumstances, either A or B or both. Okay, there is a change in the lease term. So in our case, there is a change in the lease term as described in paragraph 20 to 21. So we have to go look at what paragraph 20 to 21 says. A lessee shall determine the revised lease payment on the basis of the revised lease term. Okay, so that is basically what they are saying. So we have this one, therefore we know it's a remeasurement, and therefore we know we need to use a revised. Oh, okay, So we know there's a revised lease term. It's going from 4 to 5 years. That's a change in the lease term. So that is why we know we need to be using a revised discount rate. Okay, and they're telling you it's a remeasurement. Okay, so this is a remeasurement because there's a change in the lease term. So therefore we use a revised discount rate. Okay, the second one that will be a remeasurement with a revised discount rate is there is a change in the assessment of an option to purchase the underlying asset. So take note, it says or. So you can have this or that, but we have both. So therefore we're applying both, okay? There is a change in the assessment of an option to purchase the underlying asset. Assessed, consider, okay, whatever. A lessee shall determine the revised lease payment to reflect the change in amounts payable under the purchase option. So we have both these cases. That's why we know it's a remeasurement. And that's why we know we must use a revised discount rate. Okay, so just take note of that. What you must also take note, that there's also a remeasurement where you don't use a revised discount rate. Okay, so just take note. Okay, so just take note that under these ones, they're telling you in paragraph 42, a lessee shall use an unchanged discount rate. Okay, so that's very important. Okay, so if it relates to paragraph 42, so a change in the expected amount payable under a residual value guarantee. So if the residual value guarantee changes, or if the change rate, so an index or a rate used in determining those payments, then we don't use a revised discount rate. We use the same discount rate we use at the date of commencement. Okay, so just take note of that. That's very important to understand. So remeasurement could either be, when you do the remeasurement, you use a new discount rate, or you use an unchanged discount rate. So that's very, very important to take note. Okay. So in our case, we're using a revised discount rate because it relates to a change in the lease term, and it relates to the exercise of a purchase option. So in those cases, because it existed in the contract at the time, we will use a revised discount rate. Okay, so that's what I wanted to share with you. So let's quickly go and deal with the actual question. Okay, I just quickly want to see the chat. Okay. What I'm going to do is I'm gonna stop sharing this. I'm gonna open up Excel and we're gonna answer this question. Okay. Okay, so we're ready now. I just want to okay, so Nolu, Asufute, is that was your name? Nasipi, can you hear or not hear?
I can hear.
Okay, Nolu can hear. Okay, so you can hear, okay. So this question said discuss, okay? So remember what I said when we, you can just think of it in terms of journal entries. So initial recognition fell in the current financial year, 1 September 2020. They said, assume initial recognition was done correctly on 1 September 2020. Only deal with subsequent measurement. Okay, now they are without the reassessment part, without the change in terms, there are always two parts to subsequent measurement. One, the impact on the right of use asset, and two, the impact on the lease liability. So for the right of use asset, the impact is simply depreciation. Debit depreciation, credit accumulated depreciation. That is the impact on the right of use asset. Then the impact on the second set of journal entries is the impact on the lease liability, which is simply the payment of the lease of the simply the lease payment. So it's credit bank, and that will be split between. Then you have to have debit. So you credit bank with a lease payment, and you're going to have debits. It will be perhaps two debits. One definitely for interest expense, and the balance would go to the lease liability. Okay, so remember for lease for subsequent measurements relating to leases for a lessee, there are two sets of journal entries in subsequent measurement. The journal entries impacting the right of use asset, the journal entries impacting the lease liability. Okay, so all we're going to have to do is put that into words. Okay, so that's all we're going to do is put that into words. That's how we're going to discuss it. So you think in terms of the journal entries and put that into words. Okay. Now, in this particular question, there's a third set of journal entries. Okay. The nice part of it is that it's happening at year end. So we first, because it's happening at 28 February 2021, it's happening at year end. That means we first deal with the normal journal entries, and then we deal with the reassessment. Now, this reassessment will impact the lease liability. So we have to first discuss the reassessment in terms of the lease liability. And whatever's happening to the lease liability, that change, that amount will impact the right of use asset. Okay, so that is simply that will be happening. So what I want you guys to do, right, just take, I'm gonna give you like 3 to 4 minutes, is to discuss between yourselves. I'm not gonna put it into groups because we're not that many. So you can discuss here openly. So I know Nasipi, I don't know if she can hear, but Nalu and Asufuti, if you can discuss it, I'm gonna sit and listen just for 3 to 5 minutes. What the journal entries would be regarding the right of use asset, what the journal entries would be regarding the lease liability. Okay, so if you can just take 3 to 5 minutes, I'll stop it at 8 as now on my laptop here. It's 08:31, so it's 8:31. I'll stop you at 8:35. Okay.
Hi, guys.
So at the initial recognition, the lease liability would include the following, right? So in initial recognition, the lease liability would include the fixed payments. Okay. It would include variable payments linked to an index. Okay. It would include option to purchase. it would include, so fixed payments, variable payments linked to an index, option to purchase, and then also it would include a penalty for early termination. Okay, so now remember, like even though the contract includes the option to purchase, you only include it in your calculation if you intend to exercise. Similarly, a contract may include a penalty for early termination. You only include it in the lease liability if you expect to terminate early. Okay, so like in our case, there was an option to purchase, but we did not intend to make use of it. So therefore, we did not include it in the initial lease lease liability calculation. Okay. Now, for the right of use asset, must also know what is included in the right of use asset. So the right of use asset would have the lease liability. It would have any direct costs, or they call it incremental costs. It would include a provision for dismantle, whatever you want to call it. So lease liability, direct cost, provision for dismantle. We'll just quickly share with you where I get this information from. So I need to see where I get this information from. So here we go. So there we go. Fixed payments, variable lease payments. We have the exercise option, and then payments for penalties. What I didn't include was residual value guarantee. Okay. So what must also include is a residual value guarantee. So in the lease liability, what must also be included? Where is this now? What we must also include is a residual value guarantee. So that also gets included in the calculation. Residual value guarantee. Okay, so remember there's always 5 items that you include in the lease liability. So in our case, at initial recognition, you include those 2. Okay, the fixed payments and the residual value guarantee at 675, I think I saw. Now there was no variable payments linked to an index. There was an option to purchase, but we're not exercising it, and there was no penalty for early termination. So in the initial recognition, in the lease liability, they would have included that, the 50,000 per month for 4 years, and then the residual value guarantee of 675. Okay, so just take note of that. Now, for the right of use asset, I'm going to go back to my screen. For the right of use asset, we go back to the, now without for the right of use asset, what's important to take note, at initial recognition, what do we have? It is going to be the amount of the lease liability. It is going to be any lease payments made before the on or before the commencement date, initial direct costs, and then any for dismantling. Okay, so the other one we need to include is lease payments made at or before commencement date. Okay, so if I share again. Okay, so over here, what must include? Lease payments made at or before commencement. Okay, so just remember, let's always think about these items. So for the lease liability, it will be that, and it would be that. Okay, at the commencement date. For the right of use asset, it would have been these 2. Okay, so just take note of that. Okay, so just take note of that. So what I wanted to bring to your attention, Olotandu, is you were correct in putting the lease liability at the 2-1, but you had to also include the legal fees, because that is an initial direct cost. Okay, so the cost price would have been, if I go to the question, so if we go to the question, the cost price would have been this. Would have been this 2165616. So it would have been 2165616, and it would have been where does legal costs? 29,384. Okay, so you can see in terms of the original lease agreement, they incurred legal fees of 29,384. So if we go there, 29,384. So the cost price at initial recognition would have been the sum of those. Okay, so it would have been the sum. So that is the cost price. Okay, so just take note of that. So your discussion was 100% correct. Just you needed to include that over there. Okay, so we're happy with that, Nolotandu?
Yes, thank you.
Okay.
Very happy.
Okay. So now they asked us to not deal with initial recognition. They asked us to deal with subsequent measurement. So at subsequent measurement, we will deal with the lease. Let's start with the lease liability. Okay, so with the lease liability, all you obviously have to put this into words, right? So I'm going to talk through it and just jot down important points. Okay. So for subsequent measurement of the lease liability, the lease payments the lease payments of 50,000 Rand a month, which is 300,000 Rand, will be recognized, and okay, will be recognized. Okay, so we're happy with that. Okay, so that is basically what is happening, and will reduce the lease payment. Let me just see. Yeah. Okay, so we will, the lease payment of 300,000 Rand will be recognized. Okay. Interest expense of, so we go back to the question. Okay, so the lease payment of 300,000 will be recognized. Interest of 88,321 will be recognized, and then a reduction in the capital of, which will result in the lease payment, the lease liability decreasing by 211,000 Rand. Okay, so you're happy with that? So the lease payments of 300,000 will be recognized. Interest expense of 88, just make sure I use the right numbers, 321 will be recognized as an expense in P&L. Okay, so this will result in a reduction of the lease liability. Lease liability by 211, what did I see? 211,679. Okay. Okay, so 211,679. Okay, the lease liability will be 1,953,937 937 before at 28 Feb 21 before any reassessment, remeasurement, whatever it's called. Okay, I think it's called reassessment. Okay, so we're happy with that. Okay, so we're happy with that. Nolutan, do you follow? Asufuti, you okay with that? So all we are telling them, we are literally discussing what's happening in terms using the journal entries. Okay, so lease payment of 300,000 Rand will be recognized. Interest expense of 88 will be recognized as an expense in profit or loss. The result will this will result in a reduction of the lease liability by, so the lease liability will be that amount before any reassessment. Okay, so are you okay with that? The next part, I'll just discuss the right of use asset. Okay, so the right of use asset. So we'll say for subsequent measurement, a depreciation expense in profit or loss will be recognized on the cost of the right of use asset. Okay. Okay, then we will say the cost price is 2195, which is made up of the lease liability at 1 September 2020 and the initial direct costs, which is the legal fees of whatever that amount was, 29,384. Okay, so now you're telling them all of these stuff. 29,384, the lease liability at one of 2,165,616. All we are doing is whatever we're doing in terms of a calculation and in terms of journal entries, we're just putting it into words. Okay. The depreciation is calculated using the straight line method. Okay. The useful life will be the shorter of the useful life will, you can tell them, will be 4 years, which is the shorter of the lease term and the useful life of the asset, since the option to purchase is not exercised. Okay, so remember, you use the shorter of the lease term and use the shorter of the lease term and the useful life. If one of the two conditions hold, you're not obtaining ownership, or you're not exercising the purchase option. So if you obtain ownership, or if you are exercising the option to purchase, then you will use the useful life. Okay, so remember, if you are obtaining ownership of the assets, if ownership is going to transfer to us, if the ownership of the assets are going to transfer to us at the end of the lease term, or we're gonna exercise the option to purchase the assets at the end of the lease term, then we use the useful life of the assets. But if that is not the case, then we'll use the shorter between the useful life and the lease term. So we're telling them we're using the useful, the useful life will be based on the 4 years, which is the short of the lease term and the useful life. That is basically what you're telling them. So what I'm trying to explain to you over here, whatever we would do in a calculation and whatever we would do in terms of the journal entries, we're taking that, the calculation and the journal entries, and we're putting it into words. So that is why we're just telling them a depreciation expense will be recognized in profit or loss on the cost of the right of use asset. Now we're telling them what is the cost of the right of use asset, which is the 2195, which is, and we're telling them how we got to 2195. We're telling them that the depreciation is calculated using the straight line method, and the useful life will be 4 years, which is the shorter of the lease term and the useful life of the asset. Okay, so just take note of that. Remember, it will always be the shorter of the lease term and the useful life of the asset, unless one of two things is applicable. One, ownership of the asset will be transferred to us at the end of the lease term, or we will exercise the option to purchase the asset at the end of the lease term. So in this case, there's no transfer of ownership, but we have not opted to exercise the option to purchase at 1 September 2020. So therefore, the useful life will be 4 years. Okay, so the depreciation is I don't know what the answer is. Let me just quickly work it out. I'll also work it on the side. 2195. Let's do this. Equal that. Okay, then it is 4. So it's going to be equal to that that divided by 4 years. That's annual depreciation, but we only had it for 6 months. So therefore, we're going to say that times that. Okay, so depreciation is 275. The depreciation is 274,375. So we'll just say 2195,123 divided by 4 times 6 divided by 12. Okay, so there we're just showing them that, so that's fine. The carrying amount, of the right of use asset at 28 Feb 2021 is whatever the difference is. So it's going to be equal to, so it's going to be equal to 2195, the cost price, minus the depreciation, which is 1920625. Okay. 1920625. Okay. Before any reassessment. That is basically what you tell him. Now we will deal with the reassessment. Okay. So now the reassessment. So we will say at 28 Feb 2021, the board decided to extend the lease term and exercise the option to purchase the assets. Okay, so we're telling them that. Okay, as a result, this will lead to a reassessment of the lease liability. So you'll just say the revised lease payments will be discounted using a revised discount rate. Okay, so this is very important, a revised discount rate. Okay, so that is basically what we will say. Any adjustment to the lease liability will be an adjustment to the right of use asset. Okay, so that is basically what we are telling them. Now we just do a calculation. Now we'll just do the calculation. Okay, so now we'll just do a calculation. So we want, what do we want? We want the new lease liability, so the present value. That's what we want. So we're going to need the future value. We're going to need the PMT. We're going to need N, and we're going to need I. Okay, so what do we want? We want this. Okay, the future value would simply be, so the future value is, what's the future value now? The future value is the lump sum payment at the end. Okay, so the future value is the lump sum payment at the end. The lump sum payment at the end is going to be what we have to pay to buy the asset at the end of the lease term. So remember, they told us each asset will be 30,000 Rand. Okay, so this is simply going to be 30 times 10. 30,000 times 10 vehicles. So we're going to have 30,000, 1, 2, 3 times 10 vehicles. So the future value is 300,000 Rand, which is the lump sum payment at the end of the lease term. So what is the lump sum payment at the end of the lease term? It is simply the amount we're going to pay the lessor to buy the assets, because we're exercising the purchase option. Okay, the payments is a monthly payment of 50,000 Rand, which is the lease payments. Okay, the payments is your fixed regular payment, which is the lease payment of 50,000 Rand. Okay, N was 4 years, now it is 5 years. Okay, but remember, in this calculation, it must be the remaining lease term. So the initial lease term was 4 years. We have extended it to 5 years. Okay, so we have extended it to 5 years. However, out of the 5 years, we have used 6 months. So remember, it's the remaining lease term, which is basically the remaining number of years, which is 4.5 times the number of payments per year, which is 12, because it's monthly. So therefore, this is simply going to be 4.5 times 12. Okay. So that's a monthly payment. N is monthly. Now we must use the revised discount rate. Remember, we said we're going to use a revised, we're going to be using a revised discount rate. So the revised discount rate must be the discount rate at the change, which is 28 Feb. Okay, so now remember, I think I gave it somewhere here. 28 Feb, the revised discount rate, compounded monthly, is 8%. Okay, so we're going to use 8. So the 8%, so we're going to use 8%. But now remember, this over here is an annual rate. Because payments and N is monthly, the rate must also be monthly. So I'm going to divide it by 12. Okay, so there we go. So now we can work out present value. So I'm going to say equal present value. Okay, what do they want? What is happening here? Equal present value. What that is, okay, so it should be rate in what's next now? So rate, number of periods, payment amount, future value. Okay, so now it must be payment, okay, and then future value. Okay, so then payment and then future value. Okay, and then we'll just leave that. Okay, so now the new amount is 2470. The revised lease payment, the revised lease liability is that amount, 2740. Okay, so all I'm going to say, revised lease liability is equal to that amount. Current lease liability is, what did we say? What was the current lease liability now? The current lease liability is 1953937, 1953937. So the adjustment the reassessment adjustment is an increase of, okay, so the reassessment adjustment is an increase of that minus that. Okay, so there we go. The adjustment is 516788. Okay. The adjusted right of use asset will be, okay, so what we will do, current carrying amount is 1920625. Reassessment adjustment okay is going to be, there we go. So the revised or the adjusted revised or adjusted is going to be okay, so the revised or adjusted right of use asset is going to be that. Okay, so the revised amount is going to be 243. Okay, so that's simply what's going to happen over there. Okay, so now you will tell them that that revised amount, the revised right of use asset, right of use asset will be depreciated over the remaining useful life of the assets. Okay, since the option to purchase the assets has been exercised. Okay, so that is basically what you will tell them. Okay, so now you're just telling them that the remaining useful life is no longer the short of the lease term or the useful life. It's going to be the useful life, but it's the remaining useful life of the assets. Okay, so remember what the useful life was 6 years. So the remaining useful life is 5.5 years. So remember that the useful life was 6 years. 6 months have passed, so the remaining useful life is 5 years, resulting in an annual depreciation of, okay, so we can just do this over here, 5.5, that divided by 5.5, which is whatever that is, 443. Okay, 443,166. Okay, so that is basically what we are doing over there. So that is how it goes through the question. They ask you to discuss subsequent measurement all you simply do, you're going to write down the process of the journal entries as well as the calculation, however you think about it, right? But just make it at least logical, okay? And you take them through each step using your calculations and using your journals. But remember, to do journals, you need numbers. So therefore, we're using the journals and the calculations, which is the numbers. Okay, so that is basically how we go about discussing it, and that's your 18 marks. Do you have any questions, Rotandu? Any questions, Asufuti? Asipi, can you hear now? I'm not sure.
I have a question.
Yeah.
In the actual calculation of the present value of the lease liability, if I have a residual value guarantee, and also a situation where the option to purchase is also going to be exercised, I'm a little bit confused as to how I'm going to calculate the present value.
Okay.
So
let me explain. So if you had both, right? So let me just show you quickly. I'll share my screen. I don't share my screen quickly. So if you had, so to change this. So if you had both, right? Then over here, where did I calculate the future value? Would be the exercise price plus the residual value, the guaranteed residual value, okay? But in this question, in most cases, that is not going to be the situation. The reason being is, they told us, you should be able to see the question paper in front of you now. Yes. 5 years if ownership is not transferred, okay? So it would be 375 if ownership is not, but because we're exercising the purchase option, we're not going to be paying this. We're going to be paying the price of the purchase option. That is basically what they are saying. So in most cases, if you're going to do the purchase option, there's no need to pay the guaranteed residual value. But what do they are in situations when you're not exercising the purchase option, or if there's no exercise to purchase the items, then you will include the guaranteed residual value. I don't think in reality it will be both. So that is why they don't include both.
Okay, I see.
Does that make sense?
Yes, makes sense.
Okay.
Thank you.
Okay, so any other questions? Asufuti? Anything on your side?
No, nothing on my side.
Okay,
nothing
fine.
on your side. It's,
So
I understand where we are right now.
Okay.
No, I'm saying I understand where we are right now.
Okay.
I missed a few things though, but I'll go back to it.
Okay. If you have any questions, then please just message me and ask me. Okay. So now, if you understand your situation, I'll as soon as the thing is uploaded, then I'll share it in the groups. Okay. Okay, thank you very much, guys. I'll see you tomorrow. We will do the employee benefits part. Okay, but the important aspect over here was simply they asked us to discuss. How did we go about doing the discussion? By simply doing the following. All we did was we used how we'd go about doing the journals and the calculations and put it into words in a logical way. Okay. Thank you very much. I will share the recording as soon as it is ready. Okay. Thanks. Bye-bye.
Thank you.
Bye.
Thank you. Bye.
Bye.